Right now, everyone agrees the property market's pretty quiet. Prices are flat, rents are flat, nothing's moving, so why bother? Well, if you're only looking at the headlines, you're going to miss what's really happening underneath. You see, together, Andrew and I have built a portfolio of over 50 properties, and our podcast has been downloaded more than 10 million times over the last 6 years. So we're used to spotting changes in the property market. And right now, the market is changing, but probably not in the way that most people think. So in this video, you're going to learn what most investors are getting wrong and how to read the signs before everyone else does. I'm Ed, this is Andrew, and this is the Property Academy podcast.
And what's fascinating, Andrew, is that a lot of Kiwis look at New Zealand property prices right now and they say they're pretty flat. I mean, if I take you over just the last 12 months of property price changes, there have been a couple of months where property prices have increased, about 4 of them. There's been a month where it's been flat, and 7 out of the last 12 months, property prices have actually fallen. And so a lot of Kiwis will look at that and say, well, there's been some increases, there's been some decreases. Basically, it's going flat or slightly downwards. But that is masking what is actually happening underneath. Because although those are the property price changes, a lot of property prices going up or down by 0.5%, 0.3% per month, a lot of that is just seasonal. So property prices don't tend to go so well over the winter and autumn, and then they tend to bounce back a lot when we get to spring and especially summer. And it's very hard for people to see what that is, which is why I've just created this graph here, which takes out some of those ups and downs that are just due to it being autumn or December and January, when property prices tend to go down a bit anyway. And what's fascinating is we see that in both December and January, although property prices fell, they actually didn't fall as much as you'd typically expect for a January or a December. And so once you take out that seasonal effect, house prices actually went up in December and January, or seasonally adjusted house prices went up in December and January. Same with February, same with April. And although last month in May, house prices fell 0.6%, again, once you take out that seasonal effect, they didn't change at all. And you might say, well, Ed and Andrew, why do I really care about this? I care about where my house price is going. Why do I care about seasonally adjusted house prices? Because that shows you, seasonally adjusted house prices show you how the market is actually changing. Is it doing better or is it doing worse? That's what we really care about. And if we look at seasonally adjusted house prices, we see that over the last 8 months, house prices increased or stayed the same 6 out of 8 times. So they went down 2 times out of 8. They stayed the same or went up 6 times out of 8. If we compare that to the previous 8 months, seasonally adjusted house prices went down 6 out of those 8 times. And so it does seem to be that the market is improving, but you might not see it if you just look at, well, what happened to the Rise House Price Index over the last 3 months? We've got to look at what's happening underneath if we want to see if the market really is changing.
And if you look at the overall market, so the New Zealand market is up 2.6% since the bottom of the market, which, bugger all basically. But the thing you've got to remember is that's the New Zealand market as a whole. And so there are some areas which actually are up quite significantly since the bottom of the market, and then other areas which are really, really doing it hard right now. And one of Ed's favorite tools is the market mover. Always going on at me about this one.
Now, this is a tool I created for you guys to kind of put the data in your hands. So you could go here, find any area of the country and see how house prices are moving right now. Now, what's an example of that?
So let's take Invercargill, for example. So Invercargill, since the bottom of the market, it's up 13%, okay?
That's quite a lot, eh? I think it's about, if you want to be specific, 12.7%. But that's interesting when the whole of the country is up 2.6% since the bottom of the market. But if we look at a specific area, up 13%.
So if you bought a property, say a $500,000 property back in May 2023, which would be pretty normal in Invercargill, it could be that your property is now up $63,000. So that's actually not bad, given that we are probably still in a really bad market for most people.
Well, if you applied that to the average property in New Zealand, bought a $500,000 property, it goes up by what, 2.3%, I think we said, 2.6%. We're talking about $13,000 there. So, I mean, good, but it's not huge. But if you say, oh, but in Invercargill, it's not 13 grand, it's 63 grand, you go, oh, maybe there's a little bit more opportunity than we thought. And that's the main message we're trying to get across here, is that the New Zealand market might be flat, but what that's masking is that some places are increasing in value and some places are decreasing in value. So if you only it's like if you only looked at the United States of America average house price. Well, that place is absolutely huge. We're talking about over 300 million people. And so house prices in San Diego in California might be going up when New York's flat or going down. And although New Zealand is a small country, we're quite large in terms of the size of it, the physical size of it. And so it's normal that some places will increase in value when others won't. And I'll give you another example of that. So which parts of the country, Andrew, are kind of going up and down over the last year?
So if we look at the whole country, just over the last year, most of the South Island is recovering actually pretty well. Like if you look at its heat map, it's actually doing okay compared to other parts of the country.
And of course, people listening to the audio version of this can't see the heat map, but Selwyn District's up 3%. That's not too great. But Gore is up a massive 12.75% over the last 12 months. Southland's up 2%, Invercargill 4%, Kaikoura up 6%. So we're seeing some increases in the South Island. But if we look at Wellington, Andrew, they're still doing it pretty tough.
Yeah, Wellington's still down 4%. Lower Hutt and Upper Hutt, again, a few percent down. Like they really are still kind of well and truly in the deeps of it.
Well, South Wairarapa fell 9% over the last 12 months. So this isn't down from the peak. Wellington City is not 4% down from the peak. It's more like 24% down from the peak. This is just over the last 12 months. But if property prices are going down 9% in South Wairarapa while going up 12 or 13% in Gore, that's how you get the average of the country coming out to being pretty much flat. Even if I think about an area where my mum lives in Stratford District, which is down in Taranaki, house prices are there up 6%, while Auckland is down 0.3%. And so there's a bit of a two-tier recovery going on. Some places are doing well, some places aren't. Another place that's quite fascinating, Andrew, is Queenstown. They bottomed out at the end of 2022. How have house prices gone since then?
So Queenstown's one of these fascinating places to me. So since the bottom of the market, up 11%. So if you bought $1 million property back in, when was it? May, end of 2022, you've made $100,000. That's a lot of money. Now, I don't know if you can still buy a property for $1 million in Queenstown, but, theoretically.
And I was just looking at some data out of Cotality. They used to be called CoreLogic. And they were looking at flats and townhouses across all of New Zealand. And under their numbers, 54% of suburbs saw increasing values or flat values over the last just 3 months they were looking at. But 46% of suburbs with flats and townhouses saw property prices decrease over the last 3 months. So again, if you look at the average of everyone, it looks like there's a flat market. But if you just focus on the areas that have opportunities, you're like, oh, well, maybe there is a recovery going on. If you only look at the areas that were decreasing in value and you happen to live in one of those areas, you'd be like, actually, property prices are still going down. We're in the midst of a downturn. And so we've just got to be aware that when the average is going flat, that doesn't mean no opportunity. That means that's the average experience. One of the things we've got to think about is, well, how do we invest where there is opportunity then? And we actually see that people who invest in shares have been doing this for a long, long time. We've been hearing a lot about the magnificent 7 companies, the 7 technology companies that have pretty much been accounting for almost all of the increases in value in the S&P 500. And if you look at the S&P 500 going up in value, you'd be like, wow, all 500 of those shares are doing well. Actually, what's happening is a couple of those companies are increasing the S&P 500. The average experience of the average share might be that it's going flat. And this is just to get all investors not just looking at what is the average, but where are there opportunities for me? But Andrew, what I really want to count down is the top 5 places that have increased in value and the top 5 places that have decreased in value over the last 12 months. And in 5th place, the area that increased in value the 5th fastest is Otorohanga, which is in Waikato, up 11.6% over the last 12 months. What's second?
Westland District, and that's up 12.35% in the last 12 months.
That's the west coast of the South Island. In 3rd place is Gore at 13%.
A Portuguese district, so that's up 12.99%, almost 13%.
And the place that's increased the most over the last 12 months is Wairoa district, which is actually up 28%, which
That's
is just
insane.
Just in the north of Hawke's Bay. Now, there is something very important to say when we're talking about these small regions, because there aren't that many transactions that go on in these smaller regions, like this data can be a little bit wild.
It'll distort it.
I would not necessarily be like, man, we all got to go and buy properties in Wairoa district because the housing market's going off. Because what you'll likely find is that over the next 12 months, you might find that house prices go down, and it's just that a couple of houses happen to sell at particularly good prices. But nonetheless, this is what the data is saying, so we might as well read it out. What about the areas that are actually doing the worst in the country? Coming in at 5th place is Lower Hutt City, which fell 3.6% over the last 12 months.
Then you've got Masterton at 3.91%.
Which is actually still in the Wellington region, seeing a lot of still that downturn happening in that part of the country. 3rd place is Wellington City. We mentioned it before, which is down 4.2% over the last 12 months.
Then you got Clutha at down 5.2%.
That's a bit of a rogue one, eh? This is the only area in the top 5 worst performing areas over the last 12 months in the South Island.
Again, it must just be a couple of transactions that are making it distorted.
Especially because all of the areas surrounding the Clutha district, we find have increased in value over the last 12 months. But what is the worst performing area over the last 12 months? Is the South Wairarapa district, which is down 9% over the last 12 months. And some of these areas where we've seen house prices spiking, yes, they're not just small areas where there could be some rogue transactions, but they're also the smaller and often cheaper areas as well. And I know you've got a theory about this.
Yeah, my theory is that houses are actually now more affordable for people.
Yeah, so many people are going to say you are really out of touch. You better have some data to back this up.
Well, what I mean by that,
he is out of touch, by the way. But where's your data to support your theory?
So what I mean by that is that, yes, house prices are expensive, but if you think since COVID, house prices have gone up 25%. But our incomes in that same length of time have gone up by 31%. So it is more affordable compared to, when you think about a purchase price versus our income, it is cheaper.
I suppose what most people would think is that because we had that big spike in house prices due to COVID, of course house prices are more expensive than they were pre that. But what you probably don't see is that incomes have gone up. So if we think about the end of 2019 as a base, we see that house prices certainly did become much less affordable compared to incomes. But that ratio today is about 5% less. That ratio between house prices to incomes is 5% less than it was before the COVID-19 boom. And I think when we're thinking about this topic of the housing market is changing, but not how you think, that's probably going to be quite surprising to a lot of people. And also thinking about this kind of 2-tier recovery, it's got me thinking a lot about GDP. And I know this is a bit strange talking about the economy, but over the last 12 months, the New Zealand economy has shrunk 1.1%. And so if you think about your household budget, you might think, okay, if I lost 1.1% of my income, would I be able to cope? And the answer for a lot of people would be yes, you'd be able to cope and get through. But what you don't see when you think about GDP falling by just over 1% is that there will be opportunity in some businesses. Some businesses will have grown. Some areas of the economy will have grown and will be doing better off, and there'll be opportunities there. And in some areas of the economy, people and their businesses and their household budgets will have shrunk by much more than 1.1%. And so it's not like everybody does the same good or the same bad. There's a real distribution around this. If GDP increases or decreases, some people are still doing it tough and some people are doing well. We as investors need to say, well, even if the economy is not doing particularly well, where are we going to invest and which parts of the economy will do well in whatever stage of the market we're in or whatever is happening out in the world. And I think we can apply that same mindset when it comes to property prices. The average might be that we're only up 2.6% since the bottom of the market, but some places are up 13%, and some places are actually still at the bottom of the market and haven't seen any recovery at all because house prices are still falling.
Yeah, I think I'm thinking about kind of just some of that investor mindset that I'm dealing with at the moment. Some of my investors that are in Wellington, for example, accept that their house price has gone down, but they're not selling their house, so it doesn't matter. So if they're able, what a lot of them are doing right now is they're trying to get some investments in some of those areas where there might be opportunities. I think the general consensus of my Wellington investors is it's pretty tough here at the moment. There might be more job losses. We're not that comfortable investing here, but they do want to invest in Auckland or Christchurch or something like that. But then on the flip side, if you were an investor in Auckland and you had lots of properties at the moment, you might start to spot some opportunities in areas like Wellington in a couple of years.
The other thing is, if just like business owners wouldn't look at the GDP data and say, well, the economy shrunk by 1.1%, time to close down, not invest in this business, it's not going to go too well. If you are a property investor, you're basically starting your own property business, the business of buying and renting out properties. And so just like business owners wouldn't be like, well, GDP data is not very good. No, not time to invest in this business. It's all going to hell in a handbasket. We also, as owners of our property business, need to apply that same mindset. And if you are looking to invest, one thing you should absolutely do is run your numbers using Opus Plus. This is a free app that we've created where you can run the numbers on any investment property in New Zealand, including getting the cash flow forecast and a forecast of how your property might do in the future. You can sign up for that completely free. Links down in the description, or to be honest, if you just Google Opus Plus, it'll be the first thing that comes up.
Now, if you want to know exactly how successful investors are taking advantage of these shifts, you're going to want to watch this next video where I break down how the entire property game is pretty much just like Monopoly and how one simple shift in strategy could help you build a real-life portfolio worth millions.